please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
JP Morgan special on the eve of the third India Investor Summit. We've been speaking with Kalpana Morparia, Sajjid Chinoy and Bharat Iyer, the brains trust of JPM in India. Well, Sajjid, before we do the break, you told us 8.2 on the bonds is about pricing it or perhaps overpriced the risks. What about fiscal deficit? I mean, everyone was thrilled that the Prime Minister reiterated that commitment. But the numbers at the moment are not very encouraging. GST clocking 94,000, 95,000 crores against an asking rate of 1.1 lakh crore. Can this commitment be kept in an election year?
I think it can, because I think the fiscal, unlike current account, is a policy variable over here, and I think the government's marksmanship has been very good the last few years. GST collections are a concern. These are teething problems with compliance. I think where the government hopes to make up is on direct taxes, where the budget estimates were quite conservative, and with growth outperforming, you may get more tax buoyancy there, number one. Number two, last year they exceeded their disinvestment target. And number three, I think when push comes to shove in this global environment, I think this government, I think other emerging markets are showing that if I have to cut expenditures at the margin, that's a cost worth undertaking, because the psychological impact of sticking to your fiscal deficit target will be very important this year. Secondly, it's more than psychology, because when we bemoan about our large current account deficit, ultimately that is nothing but investment minus savings. Yes. The faster the government brings its fiscal deficit down, and the lower the drag from public dis-saving, the faster the current account deficit will narrow. So for both those reasons, psychologically to help the bond market and to reduce our elevated current account deficit, it's important that they stick to it. I think that was the most important announcement on the weekend, that there's a firm commitment in September that we will stick to that target.
Okay. Yes, clearly, I mean, there were many experts accepting that as really the best trump card. But really, being able to maintain that in an election year, well, one hopes they're able to stick to the knitting. One hopes the market is a great disciplinarian. But Bharat, what are EM investors saying in terms of levels for the next 12 months? Are they reconciled that there will be selling? After all, we have seen FI investors not participating. So what's the overall view? Reconcile yourself to a Nifty level of probably 11,000. Have you moved your target itself?
We have actually, Lata. We started this year with a Nifty target of 11,300 to 500 with a lot of volatility. Our target's just been taken out, and so we've increased our target to 12,500 to 12,700 for June 2019. The way we look at it, Lata, is first, if I were to come to the numbers behind our target and then take a look at investor positioning, I guess we all have to reconcile to the fact that cost of capital is going up, and so markets will derate gradually over a period of time. So valuations are not going to do the heavy lifting. But as I said, if you're looking at earnings growth of 14–15%, there's no reason to believe that, bar a global catastrophe, earnings can't propel markets higher by another 8–10%, which is where we are. Coming to investor positioning, I think investors are still marginally overweight on India vis-a-vis the benchmark. Okay, off the highs, but still overweight. And when we talk to them, the impression we get is India is by far one of the better emerging markets they want to be invested in over the medium to long term. Sure, they see cyclical headwinds over the near term, be it oil, be it the higher cost of capital, be it a substantial election calendar. But that said, I guess most of them are looking for these cyclical headwinds to abate. And any correction in terms of valuations or these cyclical headwinds abating will be used as an opportunity to enhance the scope of overweight.
Okay, well, enhancing your target to 12,500 itself over the next 12 months will be a positive for investors who are looking at India through the JP Morgan eyes. But that's the question to you, Mrs. Morparia. You must have been anyway speaking because of your job to several foreign investors, and especially ahead of the summit. What's the FDI view? I mean, we have done well on that parameter. FDIs will come and go. But what's the view? Do you see money coming in, for instance, in distressed assets? Are they adequately impressed? Or the IKEA variety of investors, the longer-term India story?
So clearly this year, particularly for JP Morgan, it's been very heartening. We advise Walmart on the single largest check that has been written in this sector, or period actually. So I think just given the disruption that's going to take place in India with digitization, mobility, data, etc., there is a whole lot of interest, whether it's from the large US majors, China, Japan, and we're seeing a lot of that excitement. In terms of FPI specifically, most of my discussions with clients, we touch on the periphery, on the macro, and what's happened to the currency and interest rates. But their real interest is in finding out what's happening on the ground. What are clients seeing in terms of demand? Are they at all sharpening their pencils in terms of investment? And definitely there is a whole lot of talk from some of the distressed funds in terms of looking at partnering with people for the distressed assets.
Okay, that's good. That should hopefully bring in the much needed dollars, even if the FPI's kind of boycott for the moment. The last word to you, Sajjid. What's the sense you're getting on the rupee? Have you done any math in terms of the RER? I mean, markets are never at average or at the right valuation. But if you have, worked out some rupee level, which matches the long-term RER.
So, Lata, I think that's the wrong way to look at it, because I think that policymakers in India correctly look at a trade-weighted rate.
Yes.
The dollar-rupee rate means nothing if other currencies are also moving in tandem. For the economy, it's a trade-weighted rate. And as we discussed, it went up 20%, it's come down 6.5%. Now, 2 points to note. It doesn't have to come back 20%, because to the extent that India's growth and productivity is higher than other countries, over the last 4 or 5 years, the underlying quote-unquote equilibrium exchange rate should have also appreciated. Number one. Number two, this shouldn't all happen in 1 year. So what we've seen is a healthy correction. I think the point to guard against is a self-fulfilling spiral in the rupee market. And I think it's important, therefore, that we use the instruments at our disposal at the right time to ensure two-sided volatility. If that were to happen and we move in tandem with our trading partners, which in fact has been the case the last 4 months, the nominal effective exchange rate has only depreciated 0.5% in the last 3 months. So at this point in time, if we move in tandem with other emerging markets, I think that's a healthy start. The combination of a weaker rupee, slightly higher interest rates and tighter fiscal policy should be enough in the next few quarters to compress India's current account deficit of 3% of GDP, which has to be the overriding objective in the coming quarters.
You're going with 2 rate hikes from now for the financial year?
Yes, contingent on where inflation pans out. Food inflation is again surprise to the downside, but we think that the rupee move, oil moving back up against, will have implications down the line, and I think policymakers will have to be preemptive in this market. So we're going with 2 more. Going forward. And then again, to your earlier point, if the policy rate is 7%, there's no reason why the 10-year needs to be 120 basis points steeper if inflation's under control.
Okay, no, inflation certainly, but they may just want to restrain consumption for current account sake.
Which then goes back to the more the rupee does on the current account, the less you have to curb aggregate demand.
Fair point. But just one last question, because there are so many stock investors out there watching this program. You said 12,500. What will be the leaders of that rally?
See, Lata, I think investors will continue to focus on growth, because if you look at other investment styles, particularly value, I guess the issue there is you have an economy which has moved from contraction to recovery.
Yeah.
But I think it's still very difficult to call for a major expansionary phase at this point. It could well happen after June next year, but that's unlikely to happen over the near term. So what we're calling for
not
is
the Larsons, yes.
Yes, so what we're not calling for is a modest recovery, but not an expansion, which means growth and quality will continue to outperform. So I guess it's going to be the secular growth sectors with sustainable earnings growth, visibility.
No, not the IT pharma types.
See, IT pharma, I guess they will be there for tactical reasons because the rupee is depreciating. But from a local perspective, I think it's still going to be urban consumption. It's still going to be the private sector or the banks with a very good liability franchise, given what we are seeing on the cost of capital front, and the beneficiaries of government investment in infrastructure.